All right. So yeah, you were talking about your experiences a little bit, about how you kind of
looking at
options.
Yes. So what happened is I was looking to supplement my income by training and so forth, and I looked at all these sites, guys saying, hey, yeah, we can do this and do that, and one of the things that got me was TrueTrader.net. I'd seen them, and the guy seemed legit, and I went on their website, and it seemed good, and all their testimonials on their website are, great. And I take those with a little bit of a grain of salt, but it seemed pretty good, and it seemed like, a good option. But then I said, let me search again. So I did, some more reviews, and it's funny how yours thing came up, and for my real P&L, and you made a lot of good sense when you were talking about it. And even when they reviewed you with one of the other people,
they had another review that it looks like they kind of were involved with.
Yeah, the one that you, because I saw that guy's, and I said, all right, this looks legit. He's showing, but then I did another search, and there you were saying, hey, listen, no, this guy. So it was really great, and I appreciate your honesty and integrity, because you're not going to get that from these guys. Because I've tried some, and they swipe you in with, hey, listen, this is a free webinar, and then they try to get you to buy their service. The service isn't cheap for a year and for a month. It's like this isn't cheap. So it saved me, pardon me, from losing that money. But for me, I'm just looking to see, okay, trading options is a less expensive way, I think, to get into some of these stocks that are more expensive.
The thing is, when you're trading stocks, you really only can win one way. You either pick the right direction or you lose by picking the wrong direction.
Right.
So with stocks, it's very directional. And the odds are really not in your favor. I mean, you got a 50-50 shot.
Yeah, right.
And so that's why I went away from stocks.
Yeah, so and that's what I've been trying to learn. So I've done a lot of watching other, options. How does it work? You buy the options, And so I have a lot, I understand the calls and puts, and I understand a little bit of the intrinsic, extrinsic value, but there's still a lot that I'm trying to learn and just need some guidance. And watching your videos, I saw what you were saying, and I tried to follow it, but being, kind of a newbie a little bit, it was a little bit difficult to follow. And that's why
we're talking right now and recording.
Yeah.
I wanted to get a perspective from, as a newbie, I wanted to get your perspective so we can kind of start from there. But when you say intrinsic and extrinsic value, that's maybe a little more advanced than what a newbie would know. So that's pretty good. That's a good thing to know. Basically, intrinsic value is when you're in the money,
right?
And you have a stock. You're basically, if you were 100% in the money, you would just own the stock,
right?
But then when you have extrinsic value, basically there's time value added on to the option or premium time value that will slowly decay as you get closer to expiration. So if you're right on expiration, there's really hardly any extrinsic value.
Right, because the time is already done.
Right. Time's over.
Yeah. And so I watched this guy on YouTube also. I forget what his site is. I think I sent it to you, but he had a 2-hour long, just explaining how to do this, and that's where I was learning it. And I do remember taking some other just time to study before about the Greeks and so forth. And I don't know all of them, but I know you have in there deltas. And so what I really wanted to go through is what your 2060 fly rules. And I see you use the SPX. And I really didn't understand, like in my question, a tranche, is that,
so tranche
what is that?
It can be anything. It could be apples. If you're carrying apples down the street and you have a bag of apples and each bag has 10 apples in it, and maybe you have 5 different bags, you'd have 5 tranches, right? So the tranche could be anything. Well, when it comes to this particular trade, this 2060, one tranche is just one contract at each strike. There's 4 strikes that we're dealing with.
Okay.
So that would be a total of 4 contracts, but it's just one contract at each strike is what I call one tranche. Because I created the rules, I could make it, one tranche could be 3 contracts per strike.
Right. And when you say
rules are one,
when you say you created this rule, this is, I guess, how you figure it out and over your time. Say, okay, this is the best way to go and do it. Because I also have a Thinkorswim TD account, and I was trying to follow you on, the TD, and like you clicked on, the same strike at the -20, and when you were clicking on them, underneath it lined up all your sales. For me, it didn't do that. It just did one at a time.
You have to hold the control key down as you press each one, and then they'll combine. From my experience, and don't quote me on this, but I'm pretty sure you can only have 4 legs in there at once.
Okay. All right. Yeah, because I was trying to get it to show up, and I couldn't. So that's one thing that
I should have put that down. I'm going to write that down.
Yeah, that was one. Because I was like, why can't I get it? I'm like, I'm doing everything he says to do. So just go to it now. It's SPX. And so do you just trade this SPX? Is that all you do with this 2060 fly rule?
That is all I trade. There's plenty of stocks to trade, but I like to trade the most liquid stocks with the lowest amount of commissions. You could trade SPY, which is pretty much the same thing as SPX, but it's only 1/10 of the size. So if you trade an SPX contract, you're paying the same commission as you would with the SPY, but you're getting 10 times the leverage. Okay, so when we're trading one contract of SPX, we're actually trading 10 contracts of SPY. Okay.
So but isn't a contract the same wherever you get, where it's 100 shares of a stock?
It is, but with SPX, it's more like 1,000 shares of SPY. So there's a couple of them that are more, like some of the indexes like RUT and SPX, those are 10 times. There are multiple.
Okay.
But normally, it's 100 shares. If you do IBM or Tesla, you're talking about 100 shares per contract.
So your first thing, it says all strike in the same expiration closest to 45. So that's what I did. I went down to the 45 day, and I'm looking at it right now. And then the -20 delta. So right now there seems to be 3 things in there that are -20 delta. The 29.05, 29.10, and 29.15.
And it's not that critical. You can just pick any one of those that you want. It's not like, you better pick that one or else it's going to be different.
Yeah.
It's
what does the delta exactly mean, and why the -20?
So delta really means, when I always try to associate a word with it. So to me, delta means direction.
Okay.
So if you got a 20 delta, you have a position on it that has a 20 delta, that means that you are going to get 20% of the move of the underlying. So if the underlying goes up $1, your position is going to go up 20 cents.
Okay. Okay, that's what delta is?
But delta has more than one meaning too.
Oh, okay.
So also, not only does it tell you what your position is going to do, like do you want SPX to go up? In other words, you have positive delta, or you might have a position on with SPX where it has negative delta, and you want SPX to go down. Like if you buy a put, that's going to have a lot of negative delta. So you can position your whole portfolio in any way you want, the right combination as far as direction. Now, another thing. Oh, go ahead.
Go ahead. No, you go ahead. I'm sorry.
Well, I was going to get into another subject of what delta means, but go ahead and ask me that question on this.
So you have contracts for the calls and puts. So you say same strike at negative delta put. You put a -1, and then the higher strike aim for the delta or neutral is a +1. So.
Okay, so if you're on the put side, let's just talk about just the puts.
Okay.
So what strike did you pick? 2905?
Let's look at it right now. So let's say 2905, right? And
if you want to go 50 points lower than 2905, so what is that, 28,
28.55, right?
You want to buy that one.
Okay.
So now you're done with the put side.
Okay.
Now you want to worry about the call side, right?
Okay, and I'm going to press. I'm just going to do. I have this simulated training on my thing, so I'm going to do simulated just to make sure I do it. So I got 28, right? 28.55, and I'm going to get to 29.05, which is also at a negative. So I'm going to hit the controls screen. Okay, there it is.
So one's short and one's long.
Right. So I have a 29.05, and you say -1 for that, 1 for that. So I go here. I got to add that because that starts at -10. So that's a -1, and then 50 points lower at a +1. Now, what does the minus and the plus mean?
So the -1 means you're short, you're selling it.
Okay. I'm selling that put, and then I'm buying that put at 1. Now, what's the significance of doing this? Is it saving me from anything?
Okay, the significance of selling option premium is because options will slowly decay over time, and there's a little bit of an edge in selling option premium, and so you want to sell it to make money to buy it back for less. That's the sell one, but the one that you buy is basically to cover yourself in case the market goes down significantly. You got to make sure you're covered. You don't want to be naked. You want to have it spread off. It's a spread.
I get it. So that kind of saves you in case it sells off. You're protected. You're hedging yourself, maybe.
It's a hedge.
Okay.
Yep.
Right. Okay. And on the call side of that same thing, you're doing pretty much the same thing.
That's right.
Okay. All right. And so I'm going to go to the call side, just looking at the 29.05, and the bid is 303. So you add that.
You're going to sell that one.
Right. So you're going to sell the 29.05s, which is the original one, for the same strike, put a -1 for that. Okay. Because I'm going to simulate this to see if I can. And then from there, you're going to say the higher aim for the delta neutral, which is 50 points lower again, right?
Okay. So if you sell a call, the way to cover yourself, the way to hedge yourself, is to buy a higher strike call.
Okay. So instead of the 29.05, I'm going to buy the 29.60, which is, or 55, because that's 55 over.
Okay. So you're going 50 points higher, but what I talk about is going about 35 points higher. Go ahead and go 35 points higher. That's just a starting point.
Okay.
We really don't know where this one's going to be. This one's kind of a variable.
Okay. So if I go 35 points higher, I'm at 29.35. And what am I looking for again at this 29.05 if I click it?
So now you have all 4 of those in your Thinkorswim, in your analyze?
Right.
Okay. Now, do you see where it says delta for the whole position?
Let me just change this to a +1 before I forget. A +1. Okay, and it will show me delta for whole position. Let me see. How do I see that?
Do you see where it says price slices up above a little bit.
Well, it says what again?
Price slices.
Price slices. Up above, up top, price.
No, it's kind of in the middle, just above where you put in the. Oh, I'm sorry. Okay, let me go back up. Actually, you want to right click the whole thing.
It's in red right now.
It's in red. Okay, so you want to get somewhere in red where you're not like on any of the numbers or anything.
Yeah.
Kind of like a blank space, and then right click.
Okay.
And then hit Analyze Trade.
Oh, Analyze Trade. Okay. All right. Let me go back. Hit anywhere here and hit Analyze Trade.
Yes.
What it does is it brings me to the Analyze tab up top, and it just says type of stock or future. If you want, while we're on this call, we can share the screen.
Okay, it's recording. Okay, so I'm looking at your custom order.
Right. So this is the simulation. So here is here is the delta. I changed this like you said. Here's the deltas, the 20s. And I went and picked this one, the 2505.
Yeah, okay. The 2905.
Yep. I added that down here for the 2905. The first one, so here we have 2905 is the -1 per your instructions. And then real quick on the put side, I did the same thing at the -20 and a -1. And then I went 50 lower the -20 delta, which is 28.55, and guess I'm buying that contract, right?
Yep, that's correct.
And then we went to the higher strike, which we estimated 30 higher, where I'm going to add it right here, right?
Yeah, that's just the ballpark to get us started.
Right. So now I right-click here, and I go to Analyze Trade, okay? And it brings me to here.
Ah, okay. Now you want to go up, see where it says Risk Profile? Up here?
Risk.
Do you see my top? No, you probably don't. On the top,
no.
It has a little green kind of icon. It says Risk Profile. Yeah.
Okay, right there. Okay.
Okay, see how you've added it 3 times already? Okay, so go ahead and just, like, exit out of 3 of those, and we'll just have 1.
Oh, I see. So get out of here.
Like, exit that one.
There,
like, little exit.
That one.
Wait.
Okay.
No, wait. No, on the right-hand side, just exit it. See the little X on the top right?
Sorry. Right here.
Yeah.
Right here.
Yeah, we only need 1 of those. Okay, so now see where it says price slices up in the middle, kind of left above where you put the little check mark.
Okay, up here.
Price slices, yeah, right up here, just a little higher.
Price. Oh, right here. Sorry.
Yes.
Okay,
Open
there
that up.
it is.
Okay.
Yep.
Now you'll notice that SPX right now is trading for 3170. See that 3170 right there?
31 right here, right? 3170.
Yeah, but also go to where it says price slices, and just underneath that, there's 3 prices.
Okay, this SPX. One, yeah.
So the one in the middle, that's the actual price, and then one up top is if it went up 10%, that's where it would be, and the one below would be if it went down 10%, that's what it would be. Okay.
Okay.
So
okay.
So stay on the one that says the 3171, like that one, the middle one. Now look to the right where it says Delta.
Oh, that's what I was watching your video. Okay, so you want this to be where though?
That Delta. I want it to be as close to 0 as possible. And the only way we're going to change that is we're going to move the long call. Right now it's at
this one.
Yeah, so you can move that. So put it at 2940 and see what happens to the delta. Right now it's at 0.9. Now it's at 0.49, so it actually got more closer to 0, which is better.
Right.
So maybe we go to 2945. See what that does. That's really close to 0. Let's go to 2950 and see what that does. Okay, so now it's going away. So 2945 is our best. Yeah, there you go. That's the closest one.
So what does that mean exactly? So what does this delta mean on this point? Why do you want it so close to 0?
So what that means is the whole position okay, one thing we forgot to do, which is very common, is a very common error, is we need to unclick right there where it says credit and the price, and there's a little lock. See that? We need to unlock it. Hit that. Yeah. Okay.
What does that do?
That makes the price actually real time, like it's fluctuating with the price. Like all the prices are fluctuating together.
Okay.
Okay. So that's a real time price right there. And then
do I have to do the same for this here or no?
Yeah, unlock that one.
Okay.
Yeah. It shouldn't make much of a difference. Yeah. Okay. So now you can see our delta is 0.11. It's almost 0.
Mm-hmm.
Very close. 0 delta means that if you go up, you're not really going to lose money, and if it goes down, you're not really going to lose money. Like you have no directional bias.
Mm-hmm.
Does that make sense?
Right, because then if it goes up or down, it's not going to. There's no risk there.
We are not. Yeah. So we're not picking a direction. That's one thing that I used to try to do back in the day, and I figured out that I'm not good at that. And like I said, you got a 50-50 shot. So if we don't have to worry about picking direction, we've really eliminated a lot of the potential problems with a trade.
Okay.
So that's why we move that long call up or down until we can get our delta neutral.
So now we're close to there. So this is what we're looking for according to your things here. So I'll bring this into the screen. So we did the same strike. We have one contract, and then we went negative 20 delta on the puts. So we have all this. We do
have all that.
Yep, we did this. A higher strike. Okay, aim to start at 35. So this part here is basically what we're looking to do. That's the fluctuation part where we bring it into this analyze risk profile to see and make sure we get to this 0. Right. Okay.
Yes.
That's what you're saying. Right. That's where you're presenting a goal is to be between. Okay. Do not accept lower than 30. Okay, good. So
go ahead and ask. Yeah.
So we're at this point. So we satisfied everything on the initiation?
Okay, well, there's a couple more points I want to make. So right now you can see that the delta is 0.07 or 0.10. It keeps fluctuating there. You see that?
Okay. Right here?
Yeah.
Mm-hmm.
Yeah. So let's say that if you were to move that call and that delta was at negative 0.10,
sure. Right.
you'd have to choose which one, because they're both very, very close to 0. So which one am I going to choose, right? If you get into that situation, choose the one that's negative.
Okay. Why?
It's always better to have. I'd rather have risk. I want to try to eliminate my risk to the downside. This trade has risk to the downside, but it has no risk to the upside.
Okay.
So I'd rather have negative deltas than positive deltas.
Okay.
Because I'd rather see the trade make money on the way down if I have risk to the downside.
So what is your I guess I'm jumping a little ahead. It's like, what is, how much do you think this will make? Do you hold on to it? I guess that's where you go into your management.
Well, let's go back to there's one more thing we need to look at before we want to place this trade. And that says, do not accept UEL lower than negative 30. You see that part right there?
Right here?
Yes.
Yeah, do not accept. Okay, yeah, what is that?
Okay, so let's talk about that. So push that out of the way.
Mm-hmm.
UEL is called the upper expiration line. So you can see that there's a tint, right? See the tint with the green
right here?
Yeah.
Yeah.
Yes. So upper would be to the right.
This way?
That's the left.
Right.
So upper to the right.
Way. Yeah.
Yeah. So there's an expiration line. That green line is what's going to happen at expiration. That's
this
the
one,
upper expiration line to the right.
Okay.
the lower expiration lines to the left. Go ahead and go there. Go all the way. Now, do you see the little green where it says minus $965?
Yeah, right here. Yeah.
Yeah. That's what would happen if the SPX was at 27.45 and it expired. There's risk to the downside. Move it to the right, to the upper expiration line. Keep going all the way. Yeah. Look at that. Now it's $50.
Okay.
You can move that all the way up to infinity. You will make $50. There's no risk to the upside.
Well, that's right, because you want it to go up, right? You want it to keep going up to make money, right?
You don't necessarily want it to go up. You just want it to either go down a little bit, stay the same, or go up.
Oh, really?
The only risk you have is if you get beyond that tint. What price is that down there? Keep going.
You mean over here?
Yeah, so if you hit like 28.65, that's when you start thinking, oh, there's some risk here. Right?
Oh, okay.
That's so exit.
All right. So we would exit. We would have to now, do we have any fail safes in here to sell us out at that point?
No, I don't have any type of trigger or any type
of.
You can set it up. It's kind of a little bit complicated. You could say, well, if the SPX hits 28.65 or lower, you could just tell it to exit the trade. So there is a possible exit like that.
Right.
That's not part of the course or anything, and I don't trade like that.
So if this thing goes down to 2,700, the max you can lose is 955, but still that's $1,000.
That's correct. And if it happened today, you would lose $177 or $164. You see that?
Right. Yeah.
That's today's line.
Okay. So what is this? Okay. So these lines are basically the lines of the price of where it's at right now. And so why is this thing here? What exactly is this tent?
So which line are you talking to? I'm talking about the pink
green one?
The green one is...
See how it goes high and then it comes down? Why is that?
Because you're selling those two at the top over there at 29.05.
Oh, okay.
So it kind of creates that peak.
Right.
So at expiration, you would love for your options to expire right at 29.05. That would be perfect.
Okay.
But we're not going to hold. You'd make like $3,600, but we're not going to hold for that. That's such a low probability. It's not even something that you consider.
Right. Well, is it because what is today's number? It's right now it's at 31.75. I get it. So we picked at 29.05 because that had the lowest delta.
It had a 20 delta. Yeah, it had a minus 20 delta, which I was going to get into the second part of what delta means.
Okay.
Which is when you have the 20 delta, that means you have about a 20% chance of the SPX hitting that 29.05 or lower when these options expire. It's a probability.
Okay.
Deltas can be used for probabilities.
So you're saying that the 20 delta there's a 20% chance right now that S&P or this SPX is ever going to hit that 29.05.
Not hit it. Be there or lower at expiration.
Or at expiration, which is the 45 days. Or August 21st. But do we ever really hold anything to expiration?
No, typically not.
Right.
It's happened before, but typically not.
Right.
But let's get into that final UEL thing that I was talking about.
Yeah, right. Do not expire UEL lower than negative 30.
So if you were to guess, what would you say the UEL is if you were to put this position on, just from your experience?
So let me see if I understand. So do not accept upper lower than negative 30. So this here is $30. So 28.53, right?
Okay, so remember we're talking about the upper expiration line. So go to the right of the tent.
Right.
And we're looking at that green line all the way to the right of the tent. Yep. Right where you're, go ahead and put it at the price that we're at right now, $31.74.
Oh, okay, right here.
That's where we are today, right now, if we were to open this position.
Okay.
You see down, what would the UEL be? What would be the price if this option expired and you were at that price? How much money would you make or lose?
Negative 30. So are you looking at 31.35 then?
I'm looking at the bottom left-hand corner of this graph where it says 25. It says 25 in green. 821.
Oh, down here. Okay, yeah. Okay,
now it says 35. Now it says 35.
Right.
If you were to put this position on this at this price and it expired, you would make $35 there, or anywhere above the 10th. That's the upper expiration line. That's where it's going to expire. That can't be negative 30 or more.
So you're saying, okay, I think I understand what you're saying. So right here, if I look, this red line keeps jumping, and I'm assuming that's the price of it right now.
That's
right.
Yeah.
Yeah, that's today. So if I put it at that thing right there, as long as it reads right here. So okay, we're back. I don't know why it's jumping.
It's fluctuating because the price of all the options are fluctuating.
Okay, so here we are. Here, I would make $55. So you're saying that you don't want so how do I measure that negative 30 by me moving it back? Like that?
You're measuring it. You're measuring it right now. Right now, if you were to put this straight on, you would make $35. Now look at the price. Remember where we had to unclick that little lock button where it says credit?
Mm-hmm.
$40.35, $40.50.
Right.
$40.50. You're going to have a higher UEL right now because it's got a higher credit.
Okay.
You want to make sure that you don't, when you put this trade on, make sure that you're not paying too much for, or you're getting a credit. Make sure your credit is high enough where have that UEL where it's not negative 30. So right now, if we were to put it on at 40.50, go ahead and move it back up, see what the UEL is. It would be $50.
What does that mean, that credit? Yeah.
Watch as that credit moves because the prices are moving. Right now it's at 40.50, so you get $50. When it moves, your UEL, your credit, and your trade is going to be different. Now, what that means is you're selling two options and you're buying two options. There's 40.45. Now it's worth $45 a UEL.
Right.
You're selling two options, you're buying two options. The ones that you're selling for more money than the ones that you're buying. They're worth more, so you're bringing in a credit.
So we're shorting it? Is that what you're saying?
Yes, we're shorting the two that are worth more, and we're buying the two that are cost less. That means the overall position will have theta. The overall position will have decay in our favor, whereas prices, as time goes by, everything decays, and we've got more credit than we do debit, so we're going to come out ahead.
Okay, so let me make sure I understand. So we're buying at $29.45 a call. Okay, so we're buying at $29.45, which means the price is at $29.45, but right now it's at $31.74. But we're also selling a call at $29.05. So we're shorting ourselves here.
We're bringing in a credit when we do that.
So again, I just want to make sure I'm understanding. So per your 2060 fly rule, you're going to the negative 20 because it's a 20% probability, and we want a higher striking, 50 points. Okay. So I guess part of your rule here is what does 2060 stand for? And is there anything Did that because
well, initially it was the 20. The 20 represented the negative 20 delta, and the 60 represented the profit target of $60 per tranche. We got profit target up there. I think after doing a lot of back testing, yeah, $60 per tranche is my profit target. So that's where I came out with 2060.
Okay. So now if I'm buying options, so now I want that. So I got the 2905 and 2945.
That's giving you further protection, further downside protection. That's call side. The put side is what's giving you all the premium. Yeah, but this is just to protect you, more of a protection part of the trade. And then when you do the put side where you sell and buy, that's where you bring in the credit and the premium that that's going to decay over time and make the trade profitable.
All right, so let me add that again, because then what I could do is, because you said you sit on this until you meet your 7 markers there, and we can go through that. So if I buy the puts now,
go ahead and sell that 2905 put.
2905. Let me add 2905. 2905 put right here.
Yeah, and then you're going to buy 50 points. 50
points lower, which is 29 minus 50 is 28.45. No, 55.
28.55, yeah.
Okay, so then this one.
Make sure you put it to one contract.
Right, and everything has to go. So I'm selling a -1, right? And I want the 28.55 to be a +1.
Yes. So when you
want to buy that,
so do you see how it has the bid and the ask? So if you would have pressed on the ask instead on that 28.55, it would have bought it instead of selling it.
Oh, okay. So you're saying if I click on bid, it buys.
It sells.
It sells. I'm sorry. Ask, it buys.
Yep.
Okay. So here we have -1. We have all these. Okay, so if we go to analyze our trade.
Yeah, get rid of that.
Yep. And so we're at a 1, right?
Unlock it. So it's real time. Okay.
Yep. And if we go to 40, we're too high. If we go to 45, we're at 11. If we go down to 50, we're at a -30, which is not good either. So we're still at the 45 range, which keeps the delta at around 0. Okay. Yep. So now this looks good. And how much will this cost me? This will cost you what, $5,000 to buy now?
It's going to bring in $4,000. It looks like, if I do my calculations correct. Like you can. Okay, let's just talk about trade execution. Right now, you want to get the highest credit you can get. So I wouldn't try to get 40.60. I'd put it at like 40.80. So just kind of move it up a little bit. But,
where?
Okay, so like right next to where you click the lock button, there's an up and down arrow thing.
Oh, okay.
Put it to 40.80. And see how it's locked? Now you can right-click that.
Right-click this.
And then put confirm and send. Okay. Now it's telling you right here. See how the max profit is $4,080. So that's how much money you're actually bringing in. That's the credit.
Okay.
You can see your max loss. Now
it's 920.
Yeah, because that's the lower UEL.
Okay. So
LUL.
So with your management of these and your 7 steps, potentially we can max profit of $4,000 on it.
That's if everything was perfect and you ended right at the top of that tent. But we get out of the trade early and we try to take our profits out of there early because it's way higher probability when you get out of trades early.
Okay, trades early. So so I can send this.
Sure, you can send it. It's probably not going to fill. That's fine, though. Go ahead and send it. And then go up to your monitor tab. You can see it in there. Working.
Right here.
On the top in the red, you can see where you're trying to get 40.
Oh, okay, right
but
here.
The actual price is 40.50.
So, oh, I get it. So the mark right now is 40.50.
Yeah.
Okay, so it's working. So if this goes up to 40.80, so this would have to go up in price to get this 40.80 limit.
Well, typically what you do is now you would right click in the red area, hit cancel replace, try it again. Yeah. Now move that 40.80 down to 40.70.
Okay.
And go ahead and confirm and send, and then send it. Okay, now you look at the monitor tab. See, now you're trying to, you're just making sure that you get the best price possible. So you're just like moving your price towards the market. So now you do that again and go to 40.65.
Because you don't think it's going to hit that mark.
No, I mean it could. You could sit there and wait for it, but you just want to get your order filled. But you want to get the best price possible. So you want to work your order down.
Right, because now it's at 40.60.
Yeah, so maybe you might get filled at 40.60. I don't know, but I would put it at 40.65. I just keep going down until it got filled. Then you kind of got the best price you could at that moment.
Okay. And what's an iron corridor or whatever?
Iron condor, that is a put credit spread and a call credit spread, both combined at once.
Ah, okay.
And the shorts are different strikes. So not the same strike, because if they were the same, it would be a butterfly.
Terminology there.
But that's kind of a little complicated for a newer.
Yeah. So it's at 40.55. Well, now it's going down to 40.10. It went down fast.
Yeah, so you don't know. It might go to 40.10 and then just bounce back up to 40.60. So you don't want to chase it all the way down to 40.10. You just want to move your 40.65 down to 40.60. And just kind of move it 5 cents at a time until it fills.
And what is so with that moving like this, right? See, now it's 39. But this, I'm just a little lost. This is the credit that I'm going to have. So what I want to do is I want to have the highest credit, that I can get. You're saying, see, that's 40.75. Okay.
Yes.
So it's just moving. But you want to get it filled.
You really don't know what the market is, so you have to start high and just work your way down.
Right. See, now it's at 40.60, so now we got to hope that somebody executes this for us.
Yeah. But you might go to 40.55 since you're not getting filled. You just got to kind of take what you're going to get,
Okay.
And some people are going to be super patient, and they're just going to wait, and they're just going to put it at 40.60 and just leave it there all day. It just depends on your personality.
Yeah. I'm not.
And you could get filled later in the day, or the market could just totally go against you, and you never get filled, and then you have to start over the next day.
So this is something that now you do this, and once this gets filled, then you wait on the second part of your rules.
Yeah. Then we go to the next page, guide 2.
Right, and then you look to, which is this page here that I have, and then you're looking to, okay, did you hit? And so I definitely want to go through that because I don't understand that either. But we're looking at 4.55, so it went to 60.
You move it down to 4.50. Just keep moving it down 5 cents until it fills, and you get what you get. It's not going to be, you're not going to get screwed too bad, if you just move it down 5 cents at a time.
Because you're still, you're at a good credit here at 40.50.
I mean, you're close. It's close. It's not like you're going to move it from 40.
So what am I waiting for? I'm waiting for someone to sell me, and then I'm looking to buy this and someone to sell me this. Is that what?
You're waiting for a market maker basically to take your order to make it liquid.
Oh, okay. So is that all computerized and it's a random generation kind of thing?
It's not really like a random generation. I wouldn't think of it like that, but it is computerized.
Okay.
But they're looking to get the best price they can get, because they're selling the difference between the bid and the ask of all this. they're actually they're going to hedge this position off as soon as they fill it. They're going to buy and sell certain things and make it totally neutral, and they're going to just pocket that little bit of the difference between the bid and the ask. They're going to pocket that a little bit.
So while we're waiting that to go, so in normal, say, different stocks, okay, options and stuff. So, like this morning, I was just playing around here where, I said, oh, let me try Netflix options. So I looked at the Netflix options and I did it this morning, I guess, at a bad time, because the other thing, too, is where you're hitting it. So I bought a contract at the 46-day mark, right, at 52.60, but, it went down today. But I went, so right now I bought the 465.
Yeah, the 465 call, you bought one, and you paid $52.60. Currently trading at $47.45, and you're down $515.
Right. So, but if that goes up, say I bought that option. I have 45 days to, either exercise it or, which I don't really want to do. I want to just wait for it to go up. So, my objective here is to hopefully this thing goes over $526. Is that what I'm looking for?
Well, go ahead. Yeah. I mean, if you add that, the premium adds it to the strike price. So 52. Okay. How about we do this? Now, look at the delta. What is it?
66.
So you have positive 66 deltas. That's not neutral.
What does that mean?
That means if the stock moves $1, you make up $1, you make 66. If it goes down $1, you lose $66.
Oh, okay.
You got a lot of directional risk.
Okay. So, but when I bought this, so when you do the strike is 465, right? So today, right now, it's at 491, right? So is this saying I paid $52? So basically, I paid more at $52 than what?
Okay, so subtract what is the actual price right now? 491.
491 and 465.
Subtract that from 465. Yeah, see what that is.
So it's about 30, right? Say $30.
Okay, say it's $30.
Right.
You are $30 in the money, $30 intrinsic value, and you got like $20-something of extrinsic value. Extrinsic value is what you can lose over time.
Right.
You can lose intrinsic value too because the stock could move against you and come down.
Right. But if I bought this at 465, so this is saying that I can operate at expiration, if I wanted to, in August 21st, I could buy it at 465 and say this runs up to $500, right?
Uh-huh.
Do I make any money on this, or no? Because I paid $5.
Hold on. Look at the risk. Look at the pink graph, the pink line. If that happens today, that's what you make or lose. So go ahead and move it back up to 520.
Yeah.
Okay. If that happened today, you would make $1,300.
Okay.
If it happened at expiration, you would just break even.
So right now I bought the Netflix options at 465, right?
The call, yes.
And right now we're at 491. So if I sold it now, I would lose 500. But why would I lose any money if the
market went?
Price?
Because the price went down since the time you bought it. I don't know what time it was, but more than likely the price of Netflix went down.
Yeah, so that I did it just playing around early, this morning when the market opens, which they say never really buy when the market opens.
Yeah, everybody has their own philosophy on that. That's just,
Yeah.
when you're directional, in my opinion, you're a 50-50 shot. So you just lost your 50-50 shot so far today.
Yeah. Yeah. Okay. So what you're doing here with this, let me go back here. We're still waiting for this to be filled, and that's weird because now the market's at
It should
40.
fill. I don't know why it's not filling, because typically it would fill right there, and especially with the paper trading. But
So
if you want it to fill, you can move it down.
With this being filled, right? So now, if I do this, even in like my real account, right? So you have the 4 tranches you do. So you say
that's
per
one tranche, and that equals 4 different contracts. But one tranche, yeah.
But you say per $4,000. That means if I have an account that, say I put $20,000 in, right?
Yes.
I would do 5 tranches.
That's right.
Okay. So, meaning if I was to do that, this would be 5. The quantity would be 5, right?
Yeah, it would be 5, 5, 5, 5.
And that's if I wanted to use all the money that I had in there. If I didn't, I would just use, say I wanted just to try it with the 4,000 like you have, I would just do 1.
Yes. And you'd be,
right.
According to how my guidelines are, you would be consuming up about $4,000 worth of your money.
Right.
It wouldn't show that. It would probably only show maybe only $1,500 being used up, according to Sink or Swim.
Mm-hmm.
But I don't want to. I want to be more conservative. That's too much leverage for me. If that makes sense.
Can you say that one more time?
Sink or Swim, they're going to have their own rules on how much money you have to have in the account for that.
Right.
And they might make you have $1,500 per tranche.
Oh, okay.
Me personally, I'm more conservative, and I'm going to say I'm going to allocate 4,000.
So how are you allocating? So when you buy, say, this one contract, how do you depict $4,000? I don't understand that, because you're buying.
Based on my back test, I looked at my maximum loss, and it was around $400, somewhere in that range.
Mm-hmm.
I don't want to take more than a 10% loss in one single trade. Or 12%.
But when you buy a contract, right? Aren't you buying the contract at this whatever the price?
Oh, the credit, the $4,000 credit, that really doesn't.
Back up here. I'm trying to move this around so it gets filled. So use it as a. Here is that 4065. So, but when we were looking at the trade of the SPX, right?
The 4 different legs.
Right. So here we are. So the calls. So let me go back down here and see if I can explain. So here we're still waiting. So this is showing that we have orders, right? But they haven't been fulfilled yet.
Yeah, you can probably move that down just to fill it if you want to just kind of move on to the next kind of questioning. I mean, just move it down like by 10 cents and just keep moving it down until it fills. It's kind of strange that it didn't fill. There's probably a little glitch in the system because it should fill.
Okay.
Typically, when you have a paper trade system with TOS, they fill at the mid price. So I'm just
because it's at 40.50, right?
Yeah.
So does this dictate the selling price, or does it by something else?
The mark should dictate the selling price, so it should fill.
So the mark.
So I'm surprised it's not filling. There's glitches when I use paper trading sometimes.
What's paper trading? This thing?
Paper, fake money.
Oh, okay. Yeah, the simulated trading. Okay.
Simulating, yeah.
Okay. So are they really using, how do they do that?
They usually just fill you at mid-price, whatever the mid-price is, which is what the mark is. So I'm surprised that it hasn't filled. But I said sometimes there's glitches and it doesn't fill.
With the fake trading, okay.
But now, actually, you can go to your canceled orders. Let's try this in your kind of cheap way. See where it says canceled orders?
Mm-hmm.
Yeah, there. Just right-click it again. The 40, sure. Right-click that.
This one.
And just put create duplicate order. And then confirm and send that in. See if it fixes that glitch. No. It's not filling it. So you gotta work it down until it fills.
Okay.
So that's called working the order. That's what you're doing right now. You're working
the order. Okay.
Yeah. Not filling, so you gotta keep working it. I think if we were in real money right now, it would have filled, but keep working it.
When they do these fake trades here in this simulated training, it's not really going to the market, is it? And
No.
Trading it?
It's not going to the market. They're just filling it based on the mid price, whatever the mid price is.
So basically, it's think or swim software that should be doing it.
Yes.
Yeah. Okay. And then, all right. So I get what you're saying. So we're gonna work it till this fake system finds it.
If we were in real money, we would be filled by now.
Got it. All right. So I put it up
here. Weird.
to match this. But when I'm trading like options regularly, like say I just wanted, say I just wanted to do a long call. So if I go back to trade, right, and we'll just use something else, say Amazon, for example, right?
Sure.
And I want to trade Amazon. I'm looking at once the data comes up. So my theory is I think it's going to go up. Okay, so I'm picking. Say I go out to 39 days from now, right? So are these ones in the money? Is that why they're that color?
Right. They're colored in a certain manner.
Right. So these are all considered within the money because right now, Amazon's up to $3,000.
That's right.
That's crazy.
See where at the money is, where they kind of meet at the money.
Right here
30, right. 30.10 to 30.20.
Right.
30.12. Yeah.
At the money. So basically, if I wanted to buy this stock, so it doesn't make sense. So at expiration, what I really want to do is I think it's going to go up higher. So I think it's just going to. So do I want to buy it at any of these prices and say, okay, well, if I buy it, the lower I buy it, the more money I can make later on, right?
The higher the delta, the more the directional risk you're going to take.
So this number here, right? So am I looking like you can't even get to a 20 deltas because it's all negative delta, right?
So let's just talk about calls to make it more simple.
Oh, here's the delta for them. Okay,
yeah.
My bad. Okay, so I'm looking. So
mm-hmm.
Yeah, the lower. So if you go on your 20 delta, right?
Yeah.
We're looking at the 3,400. But if
right.
I buy that, so I'm going to buy a call. But then if I buy that call at 34, but I'm thinking just straight calls. I'm not.
You got like a 20% chance that at expiration that stock is going to be 3,400 or higher.
Right. So basically, if I wanted to towards expiration, like say I buy the 29.45 calls, right?
Sure.
So I buy that, right? And that's telling me that I'm paying $189 per share, all right?
No, you multiply it times 100.
Right. Which is for the whole thing is 18,000.
Yeah.
Right.
Yeah.
So I buy that for 18,000. Now I have that call is 18,000, right? And the stock strike price is 29.45. Well, right now it's at 30, right?
Yep.
If I bought that and sold that in the same day, would I make any money? Because now, but no.
If you bought it and sold it right now, you would have to buy it for $197 and sell it for $191. See that?
Oh, okay, right here.
That's where a market maker makes their money.
Okay, so I would need to, if I buy this now, I would be buying it for $109. Okay.
$199. You couldn't sell it right away. You take a loss.
Right, because
slippage.
Because somebody's only offering $191 for this.
That's the market maker, typically, yeah.
Okay. All right. And so I would need to I would hold on to this, right? Because if I hold on, I have 40 days, 39 days. So I hold on to this, and as say their stock keeps going up and up and up, it becomes more valuable, right? Because then I can go back and look and say, all right, well, the 29.45s today are selling for 200, let's say.
That is correct, but you have to understand that when you buy an option, time goes against you. So instead of being 45 more days, now there's only, say, 5 days later, there's 40 days until it expires. Mm-hmm. So now you're losing money based on that. Mm-hmm. If the stock doesn't move, it just stays the same in the same spot, you're typically going to lose money over time when you buy options. And typically buying an option is going to be a low probability. You're not going to win. You're going to lose more than you win when you buy.
Okay. So this is why your system here covers you either way.
For the most part, it basically sells premium because selling premium has an edge to it in terms of over time you make money. But you have to protect yourself because you have these big volatile moves that can happen while you're in your position, and that's what you don't want. You need to have those hedges. You need to have those longs.
I guess I don't fully understand the option market, I guess, because I would think, okay, you buy this option, all right, and you wait. Okay, so I think that Amazon is at $3,000 today. I think it's just going to go higher, and it's going to be $3,500. But you're saying
all that extrinsic value, you've got to overcome all of that. Remember that $20 or whatever it was over? It's got to go up by $20 by expiration just to cover that extrinsic value that you paid for that put.
Okay, so
does that make sense?
A little bit, because I'm trying to figure out because I'm relating it really to the strike price, and what I mean by that is, so here's SPX again. So if my strike price is, if I bought this strike price, what's it at today? It's 31.67 today. So this is in the money, probably, right? 31.70 is in the money.
Are you talking about a call or a put?
A call is okay. So right now,
31.70 would be three points out of the money. So it's 31.67 is the current trade price.
Right. So would this be at the money, considered one of these at the money? 31.60.
Yeah, because we're trading at 31.67, and you're between 31.60 and 31.70. So that's at the money.
So these are at the money. So if I bought it today at the money, right? Because I think it's going to keep going up, right? And so, in 39 days, the August 14 expiration date. This is at the Delta 50.
You're gonna be placing a low probability trade. In other words, you got a lot of leverage. You can make a lot of money, but most of the time you're going to lose because it's a lower probability when you buy options.
What does that mean? Lower probability when you buy options.
So go back to the Analyze tab and click on the trade that you made with Amazon. Was it Netflix?
Yeah. Where is it all? Let me see.
Put Netflix in the.
I'm sorry.
Yeah, up there is the underline.
Yeah.
Now go. Yeah. Okay. So
this one.
when you place this trade, let's just say the Amazon, Netflix, what was it trading when you placed the trade? Let's just say that it was trading about $500. So move your little cursor to 500 right there. Now,
Right.
all right, you're long, right? You want it to go up or to make money, but you got to go. You bought it when it was at 500, but it's got to go to 5. Put it to that little red mark over to the right. It's got to go to 517 for you to make money with that at expiration.
Okay.
You're already up against it. You bought at 500. You want it to go up, but it's got to be higher than 517 for you to make money at expiration. You're 17 points in the deficit in the hole coming in. That's a low.
Is that because I bought it at a higher price this morning?
It's because you paid extrinsic value. You paid for the time premium. You paid for the leverage.
So when you buy options, say I want to buy options on a different stock, what do I look for? Like, say I like a stock, okay, and I think it's going to go up. And what am I looking for to really make that trade? Like you said,
how much risk do you want to take? Do you want to be super risky, or do you want to not take much risk at all? If you don't want to take much risk at all, then you just buy the stock itself.
Right.
If you want to be super risky, you buy something further out of the money that costs a lot less, and it probably is not going to make you money.
Mm-hmm.
But if it does, it's like a home run. And so it depends on the delta. So the delta could be very low. It could be 10 delta. So it means you got a 10% chance of making money.
Mm-hmm.
But if you make money, it could be a lot.
Right. It's a big
or you could
risk.
buy something with like a 80 delta where you're not taking as much risk. Right.
So the higher the delta, the less risk?
Right. If you're buying options.
Right.
I mean, from a point of view of probabilities, yes.
Right, because the delta is really telling you what the percentage of you making your money on that. So if I go with, like here, a 93 delta.
You're deep in the money doing that, right? You're almost buying the stock.
Right. So it's not even, okay.
But a lot of people like to do that. They like to do what they call the poor man's covered call. They'll buy that really deep in the money. Instead of buying the stock itself, it's cheaper to buy the deep in the money because it doesn't cost as much money.
Right.
And then they'll sell a call against that. And it's like a covered call, but it's a poor man's covered call. There's a lot of different strategies, but just to me, they're too directional. I don't like those strategies. I like things that are non-directional. They're going to pay me over time on a consistent basis. And there's not a lot of volatility. In other words, my P&L is not fluctuating so much. That's what I like.
So with this, once we get this filled, it's basically then we work on the check. You check your positions every day, like you said.
Yeah, like we can put that in the simulator. Just I don't know if it's in there right now, but go to analyze it, analyze trade. We just pretend like we filled it, and we can kind of work from there. Now, like uncheck everything except for that red box. Okay. Say we got a price of $40.10. It's locked in at that price.
Mm-hmm. Mm-hmm.
Okay, so we can pretend like that's our filled order, and we can go from there. So what would you ask me?
So the first question you have is, did this position hit profit target? How do I know that?
So in order to know what your profit target is, go ahead and right-click in the red area and hit Analyze Opposite Trade. Now you got two trades in there. Notice everything is zero all across the price slices.
Okay, right here. Yeah.
Yep. And down below, see all the zeros, delta 0, gamma 0, theta 0. Wait, open that back up, the price slice?
Oh, I'm sorry.
Yeah, that's what I was looking at.
Oh, right here. Okay.
Now, let's say that you got a credit of $40.10. Well, you want to buy it back for cheaper. So move that one that says debit, move the price down to $40. Yeah. See, as you move it down, how much money you're making? You made $10. Keep going.
Where am I seeing $10? Oh, right here.
Yeah. Keep going down. Move it down till you make $60 because that's your profit target. Right there. That's the price you want to buy it back for. So you would put an order in for that. And when it fills, you hit your profit.
You lost me there because so how do I know, like, did your position hit profit target? So am I so this is where I find my profit target. So I know $60 here. So every day I have to look and see if this number hits $39.50.
Okay, so what I would do is if you right-click that green area, I would go in here and I would put create order, like right-click it, hit create duplicate order. And then on the right, see where it says day, kind of close to the dollar amount to it. Yeah, GTC. Now, GTC means that this order that you're going to put in, it's going to stay there until it fills. Like tomorrow it'll be there, and the next day, and the next day. The only time that it'll disappear is when it fills.
Oh, so this is something that you have to do in conjunction of what we just tried to do.
Yeah, that's what you do after you get a filled order. You now put in the order to fill it for a profit.
Okay, so I think I understand.
There. And it sits there every day, and it's there. So when you open up your platform, you look at it, and if it's still there, it didn't fill.
Okay, so you just keep waiting. So this could take a couple of days or whatever, and then it fills. So if I look at, all right, so let me write that down because I got to remember.
Yeah, so if you look at that, number one, did the position hit profit target? Well, if it's still sitting there as an order, no, it didn't. It's still waiting.
Okay, it was called duplicate, right? You said it was called create duplicate order. Okay, so once filled, do a dupe order. Okay. To hit $60 price
per tranche. If you have two tranches on, you're trying to get $120.
So you're saying per tranche. So if I wanted just to risk, so that depends on how many I purchase. So if I only purchase one tranche, which is you're saying is which is $4,000, right?
Yes.
Okay. So if I purchased only one, then I'm just going to do. So do you do this every day? So once you fill it and it makes you money, then, okay, I'm going to buy again using your same theory.
Yeah, just start over, rinse and repeat.
And each time you're making money.
Yes, and I would say probably 90, I don't remember the exact numbers off the top of my head, but it's in the 90s, 95, 97% of the time it hits profit rather than taking a loss.
And so when it fills this, you could either profit or lose, you're saying?
No, it won't lose.
Okay.
If it fills. That's just question number one. If the price goes below the 10th, that's when you take a loss and you get out.
Go through, did you hit the profit target? So if you didn't hit the profit target, if yes to any of the above, take position off and open a new position. Okay, I see what you're saying. So did the position hit? No. If no, then go to number two. Our position deltas lower than -3 per tranche. If it's no, so what does that mean? Our position deltas.
We have to look at that in the Analyze tab. You have to look at that trade.
Okay.
Analyze the trade, and then the order entry thing, just exit that, or hit that little arrow button to,
Okay.
So if you're looking at the trade, you can see the delta is 0.12, 0.10, 0.15.
Right here, you're saying?
Yes.
Okay.
If it gets to 3, as high as 3 per tranche, or as low as -3, then you have to do something.
Oh, okay. So right now it's at 0.11, that delta.
Yes.
So if it hits 3, so you're saying this would be 3.0 here?
Or higher.
Okay.
0.13. Or
right.
-3.0 or -3.1, you know.
Okay. So if that hits that, then you have to do what? You have to, if yes, so move negative back to neutral by rolling long call down.
And that's, you have to see an example of that in the course. I'll have an example of that.
Okay, yeah, I'll go through I'll watch these videos, but I think, and then this will help me understand at least what you were talking about in each course, and I'll rewatch these because I think I have an understanding now better of what you were speaking of on these. So I don't want to hold up you anymore because I've taken a lot of your time, Carl, and I appreciate it. These 2 hours here.
Yeah,
so,
no problem. I'm glad that you were able to help me out by letting me record this, so it's going to help a bunch of people.